before I get into my presentation, I should note that I'm here on behalf of him, and he's been instrumental in my career, and he couldn't be here today because he is about to become a grandfather. So I'm stepping in for him today. You should also note that I'm not just some stranger from the street that Jeff has plucked. I've been doing this for 3 years, despite my fresh face. I'm relatively experienced, say relatively, in the mining and metals industry. As you can see there, you might recognize some of those faces: David Morgan, Peter Kraut lurking in the background there, and Ronnie Sturfler. I've had the pleasure of learning from all of those people, and I'm very grateful for the experience I've had. Beyond that, it's worth noting that I'm based in Latin America and have been for the last 2 years. There's me in Argentina, in Salta, at El Cavar, at Argenta Silva's project, and also at Abra Silva's Diablillos project. But I've also been to Mexico, Colombia, and I feel like it's really helped my overall knowledge. But with that said, my journey into mining was not the plan. My plan was to be a financial advisor and work in wealth management, part of the traditional system, if you will. That original plan changed after I saw the 60-40 portfolio when I was a university student. 2022 was an inflection point for the 60-40 portfolio. It was the first year that we'd really seen 17.9% decline, which was the worst we've seen since 1937, which was a 21% decline. And it was also the first year in which stocks and bonds had a double-digit decline since 1980. So it was an inflection point. At the same time, when I was studying, I was very aware that gold was undervalued relative to the S&P. As you can see here, it's trading below historical lows, and it's not just gold either. It was silver too. So gold was undervalued, but silver was undervalued relative to gold. And back in 2022, when I was doing my research, you needed 85 ounces to buy 1 ounce of gold. Today, you need somewhere around 50 or 60. But in ancient Egyptian times, you needed 2 ounces. So there's still plenty more to go. Ultimately, when I was doing my studies, these were some really important sources that I used to educate myself. Up there on the top left is the Secrets of Money series by Mike Maloney, who's one of Jeff Clark's friends. And he released a free YouTube series explaining what money is, what it should be, what it was. And it really gave me a better education than I got at university, to be quite frank with you. Also, the Four Horsemen documentary featuring David Morgan, one of my mentors, has been a really useful source. The In Gold We Trust report, putting the numbers together and telling the story about gold for 20 years now. And also, of course, Peter Kraut, the great silver bull himself, who I work with today. Ultimately, my decision to leave university was inspired by the aforementioned reasons. And this is the letter that I wrote after dropping out in search for a job with the people that I just showed you. I'm not going to read it all, but I'll just give you the brief idea. I said, my name is Ted Butler. I believe that the majority of investors today are under the illusion of diversification. They believe, or their financial advisors have led them to believe, that the traditional stock, bond, cash portfolio will sufficiently protect against the counterparty risk facing their money today, when in reality, the advisors peddling that false narrative are drastically failing to fulfill their fiduciary obligation. And I go on to talk about the reasons for that and why I believe that at the time. But I'll just be honest with you, the university students in my class were not interested in gold and silver. They were more interested in crypto, Bitcoin, and look how that's turned out for them. Since I wrote that letter, I've been proven right in a big way. Gold up 180% since 2022. Silver up even more, 243%. The S&P 500, relatively less impressive, 47%. And the 60-40 portfolio, which is represented by the Vanguard Balanced Index Fund, is only managed a 6% return since 2022. Bonds themselves down 11%. Talk about the illusion of diversification. Ultimately, as you might expect, I believe that that performance was driven by the factors that I just spoke to you about, that you saw in my letter. The first of these is US government debt, which, as you can see, is on an unsustainable trajectory. Exponential would be an understatement. We reached 39 trillion in 2026. We're about to see $64 trillion of debt in 2036, and that's in a conservative scenario, according to Bank of America. That means that in 2036, debt levels would be twice that of 2023 and 3 times that of 2018. If that was a person, no bank would approve any loan for them, but yet because it's the government, we call it diversification or, debt management, which is just not. The other reason that motivated my ultimate dropout from university was looking at the US dollar purchasing power, which has absolutely tanked since Nixon made that fatal error in 1971. Obviously, what he did was he decoupled from gold and basically cut the link between gold and convertibility, we'll say. All fiat currencies are bad store of values, but the US dollar is simply the least dirty sheet. So it will probably be the last to die, but it definitely is on its way out, as you can see. And they actually become worthless until they become worthless. You see what I'm saying? At the same time, record military spending, right? This is something that maybe is overlooked. Global defense spending reached record highs in 2024. At the same time, you've got geopolitical uncertainty in the risk index increasing and staying above 1 for the last few years. That's a new normal to me, and that started after the Ukraine war. Again, Trump is a perfect example of that, wanting to basically double the not double, but increase by 50% the US military budget to 1.5 trillion. Already the interest payments on the debt is 1 trillion. So I don't need to give you any more on that. The elephant in the room was central bank gold demand. Everyone knows about this by now, but it's important to show that throughout 2010 to 2021, 500 tons annually is nothing compared to 1,000 tons annually, which we've seen over from 2022 to 2025. And all of that's fueled by the Ukraine situation, the weaponization of the US dollar, which ushered Russia into wanting to have gold in its portfolio. And so this is the big deal, right? This is the problem. Despite all of this data, despite all of this comprehensive evidence, there's only a 2% allocation of gold and precious metals held by financial investors. And that was in 2024. It may have increased slightly since then, but that is way below what it should be for a diversified portfolio, in my opinion. Can I get a show of hands? Who has had more than a 2% allocation to precious metals over the last few years? So you guys know what you're doing, right? Financial advisors don't, unfortunately. And then you've got to ask the question, why? Why would they not want to allocate to gold and silver? And I think it has a lot to do with the incentive structures. These funds that they're peddling and that they're pitching to people probably have a very, very high fee, and more so than putting their clients into gold and silver, which is the honorable thing to do, and it's what they should do, but they don't, and I'm saying they should. And so this illusion continues, albeit in the short term. Smart money under the illusion of diversification. You see the Bank of America did this survey and shows that 50% believe that long gold is the most crowded trade for the second straight month. But I would disagree with that. What I'm trying to say is, in the short term, the bankers might be bearish. But if you look at the long-term cycles throughout history, gold and silver remain incredibly undervalued relative to where they have been, which is why I would urge you to consider this old adage by one of my inspirations, Warren Buffett, which is to be fearful when others are greedy, Just because the bankers don't like gold and silver right now doesn't mean we should all be scared and take profits, because actually there's a lot of upside that I'm about to show you. This is a really important chart. Now, it doesn't show the real return. The real return of gold is actually high. It's called the cumulative return. And what it shows is that from gold's breakout in 2024 up to today is about 80% cumulative return. But if you look from 1971 up to 1980, you're looking at a 320% return, which is to say that gold today is potentially 1/4 of the way through the bull market overall, right? Which is very positive. By the same token, silver is up around 140% so far, and the parallels between that drop there in December 73 to where we are today is actually visible in the chart. And in the 70s, it went from up 420%, which is to say that we're maybe a third of the way through silver's bull market today. But of course, at this time in the bull market is when the stocks start to outperform. This is a chart from Pay Dirt, which is Jeff Clark's book, and it really shows that on average, the stocks perform on a 3 times leverage to the gold and silver prices themselves, which is great news for these guys. At the same time, you've got free cash flows exploding. I'm sure you've seen this chart multiple times today. We've basically got 4 to 5 time increase since 2024 in the free cash flows of these 3 big gold producers. And obviously that will ultimately feed in to acquisitions and mergers from the developers and exploration companies that we've got sat with us today. And don't forget about the commodities. This is not all about gold and silver, right? There are other areas in which you can diversify. Uranium is another great example. We've got a uranium company today. Oil is another worthy example to consider, and extremely undervalued relative to historical cycles, which tells you that in addition to gold and silver, investors should also be considering commodities more broadly. Here's a bit of a joke to finish. 60/40 portfolio has been argued as lower risk, but it's now firmly outdated, unattractive, and dependent on old schools of thinking. That's one of the most disgusting cars I've ever seen, by the way. It's called a Fiat Multipler. I would never buy one. On the other hand, you've got a Ferrari on this side here, which, yeah, potentially it's higher risk. Yeah, you're probably going to have a few stomach troubles from the volatility, but it's a greater capacity for outperformance. And the power of the commodity cycle at this point, as I just showed you, how undervalued things are, is immense. So here's what I hope you learned today. Think twice before trusting the 60/40 portfolio again. It's old, it's outdated, it doesn't work anymore. And without gold and silver, it's not going to be fully diversified, quite frankly. 2022 was an inflection point for the new gold playbook, as we called it in the In Gold We Trust report. Mining stocks look set to outperform at 70 to 80% profit margins. 1970s returns suggest the best is likely still to come from the mining stocks in particular, if you look at how early we are. And ultimately, gold, silver, and commodities should have a higher weighting in future portfolios. I really do believe that. And I think we need to call those financial advisors who failed their fiduciary obligation, like I said, we need to call them out and say, well, hang on a minute. You should have put your clients' funds into a so-called pet rock, and you would have done better than putting it into the so-called diversified portfolio. So in that sense, you should choose your financial advisor wisely. That's what I would urge you to do today. I hope you've you've enjoyed the presentation. It's one of my first ones, so hope I didn't do too badly. And here's where you can find me. Ted J. Butler on X and LinkedIn. And I also write for the Silver Advisor with Peter Kraut. I'm here, like I said, today on behalf of Jeff Clark, the Pay Dirt Prospector. Thanks for listening.